Hey guys, welcome back to the channel McNallie Money, the new home of power mining analysis. In today's episode, we've welcomed Paul Prager to the show. He's the CEO of TeraWulf. They just came out with Q1 earnings, and in addition to that, we're going to be talking about their outlook and growth strategy for the remainder of 2024 in today's presentation. Now, before we get into all that, please take a second, smash the like button, you guys. It's a big help to myself and the channel. If you're not already subscribed, McNallie Money, feel free to join. And let us know in the comment section below if you're part of the Wolf Pack, if you're currently holding shares, and your thoughts on TeraWulf compared to their peers in the Bitcoin mining segment. Now, with that being said, let's get into today's interview. Okay guys, so that's right. Today's video, we've got the CEO back from TeraWulf, Paul Prager. We're going to be going through earnings. We've got a list of questions from the subscribers. A lot on the agenda today, but first things first, Paul, great to see you. Thanks so much for being back here.
Nice, thanks for having me back.
Always a pleasure. Now, we're starting to see a lot of earnings come out from the mining companies. Last week, we had a lot of the HODL companies. This week, we have a lot of the non-HODL companies. We'll get into some of that complexity in a bit here. But before we do, can we just get a quick high-level summary of kind of the earnings, some of the highlights and key takeaways, Paul?
Sure. We self-mined a ton of Bitcoin, averaged about 11.5 Bitcoin per day, which was a 10% increase over Q4. And then we had an adjusted EBITDA of 32 million, which reflected a substantial 95% improvement over Q4. And more importantly, what we want people to think about is, just how much profit we make out of our exahash. So we're trying to show people this notion of, EBITDA to exahash is a way to think about the market. We had a marginal cost to mine of 29,000 in the first quarter, 24. And I think we're going to be, around 40,000 now post halving. Reduced debt by over 70 million since the beginning of the fourth quarter of 23. So I think from a financial and operational perspective, it was really great. It was a great report. We didn't get the kind of positive feedback that we had hoped to be honest with you, from our earnings, given our success. And I just think we need to do a better job of communicating how we're thinking about it, why profitability is so important, and that there is a possibility to have measured dilution when those dollars are used for real profitable growth. So, but that the investors need to, I hope, distinguish between growth versus profitable growth. And so hopefully that would be something in our favor and would bring an investor under the Wolf umbrella.
Of course, a new member of the Wolf Pack. So let's get into that a little bit, Paul, because Anthony and I were talking about that as well. And when you look at the valuations on a per exahash basis, you've really got a wide range of companies. Some are in the 20, 30, 40 million dollar range per exahash. Some are in the 160 million dollar range. And you're right in saying, Paul, that the market has valued, different things differently for companies. Now, we had Hut 8 Mining on yesterday. Sue Ennis was talking about some of the investment banks she was meeting with and some of the sell-side, buy-side analysts. And they were really saying, due to a lot of this ATM activity, the constant dilution, some of these companies just aren't investable from an institutional lens. And she was saying that herself, alongside with Wolf, you guys have really taken a different strategy to that growth, that managed growth. Can you talk to us a little bit about that mentality, Paul, and why you think this is a better long-term approach to the market?
So I can't speak to Hut. Because we're a very different company. We're long energy infrastructure and at really low electricity prices. So that's what we're really about. So I ultimately believe that we'll stand out in the pack, if you will, because while we're not necessarily generating exahash today, we're generating increased value. Think about it. If Bitcoin's going up and the value of your exahash is going up, then inherently the value of our asset base and our energy infrastructure is going up because we have the megawatts that make the exahash. So we're not getting valued for that right now. So I think one important thing to address is that would provide a real value shift, I think, in the space if people recognize that, and our stock would be trading at a very, very different level. As CEO, you can't really worry about the stock price. You got to worry about the mission and execution on the business. But I'm sensitive to the stock price because I've got shareholders, and many can be frustrated that we're down where we are. So one thing I think some of our earnings are misunderstood just because of the way GAAP works. For instance, Nautilus isn't consolidated in our equity and net income, loss or gain or whatever. It's not consolidated into our revenue. It's a special line, and it's reflected in that equity and net income line. So because we're not consolidated up top in revenue, and we just have the little bullet below in equity and equity in net income, I think people can't really compare apples to apples, if you will, when they're looking at us on a comparable GAAP basis. Because a lot of analysts model their business, in a consolidated way, and you can't do that because you're missing out on Nautilus.
And that's because of the joint venture nature of Nautilus?
We're in a joint venture with Talon, as everybody knows, and so we just can't do that. The other thing on the debt, we got hit with a GAAP interest expense of $11 million, but our cash interest expense was really only $3 million, and that was because of the warrants. So I think, we've tried to explain that to people. I know Patrick I think, done a really good job of getting that out there, but I think for those that are frustrated by GAAP, and I can't blame them, I am too, these are some of the challenges people have in interpreting our financial results. I think also it is hard to think about this business because you got to think about dilution on the one hand, right? Profitability on the other, and growth on the other. And I think that when dilution is in the rearview mirror, nobody cares. So if you take a look at our results, we haven't had really very much dilution relative to guys out there with a whole lot more. On the other hand, people like CleanSpark have executed that strategy, in my opinion, really well, right? They diluted, they grew, and boom, look at where they are. We chose a different path. We chose that path because we're significantly invested in the company, and we want to minimize dilution, use our free cash flow to grow, right? And make sure that every dollar we invest in growth is really, really profitable. I don't know if everyone has that view, but that's our view. I think, dilution shouldn't be a dirty word if you can have profitable growth. And I think we've proven as a team that we're capable, look at our earnings, 32 million, 8 exahash. I mean, it's pretty great. I think we've proven to be prudent fiduciaries of the capital so that a dollar invested is going to mean return to the investor. There are those who followed a different strategy, of course, and I think, everyone should, if that's what they want to do, that's great. But I would be concerned if there was dilution for growth and it turned out not to be profitable. And so the way I would, if I was an investor, look at that is I'd go back to what is the SG&A and what are the power costs? Because those are the ways to sort of think about whether or not anyone's going to be profitable. And I can't speak for anyone else, but I know in our case, one reason why our EBITDA to exahash is as favorable as it is because we run a very tight ship on the SG&A, and we get the most out of our dollars so that exahash really performs in the return of revenue.
Certainly.
So it's the market's fragmented. There are a lot of different views out there. Yeah. The one reason I'm not worried about us taking our, if you will, turtle-esque approach to growth in this regard is because we have the energy infrastructure. So that while maybe someone else is putting up huge exahash numbers out there or projecting it and then diluting to achieve it, I think we already have that energy infrastructure that intuitively is increasing in value. The hyperscalers are buying it all up. And then, there's a whole nother level behind it, guys like NVIDIA and stuff. So I think that our energy megawatts are increasing from an asset value, and we just need to convert on that at some point. But I don't think we need to convert immediately, as much as really be thoughtful in how we balance our approach to revenue. I was on Mike Alfred's podcast yesterday, and a fella had a very, very good point about building a business. He said it's like a three-legged stool. It's got to be really stable, it's got to be secure, and it's got to have different sources of revenue. So for us, we have Bitcoin mining, and I think I would ask you to look at Lake Mariner and Nautilus and just tell me anybody that's creating that kind of revenue out of that kind of, exahash. Separately, we're going to have a data focus. I think in our earnings, Nazar tried to explain what our approach is in terms of a colo. But more importantly, we have the megawatts, and the megawatts are constantly increasing in value, and it's the kingpin to our business. And so that is how we would hope people find value in Wolf going forward.
Yeah, it makes sense. And we're starting to see more and more reports now, Paul, about how not only scarce but valuable these data centers and power are becoming. I've heard from a number of CEOs, it's just very rare or almost impossible to find 100 megawatt sites now in the United States that have access and infrastructure and things like that. So can you talk to us about what kind of value this brings to your portfolio? You guys obviously have an extensive history in the energy space. And we are seeing a lot of these pure play miners now rebranding themselves as energy infrastructure plays that happen to use that energy for Bitcoin mining at this point in time. So I'm curious to see with this infrastructure, how you feel that sets you up for AI, HPC, things like that in pursuit of those alternate revenue streams.
Sure. I mean, Goldman came out with a report, it was just the other day. Morgan Stanley's got a report out there. I mean, the bottom line is the hyperscalers are looking for sites, and the hyperscalers aren't looking for 100 megawatt sites. They're looking for 300 megawatt sites, 240 megawatts at the least. And and that goes with a lot of land. It's got to have contiguous land, and it needs to have water permitting, and it's got to be green power for the hyperscalers. So I say this with real humility. I don't know if there are other people out there with those kinds of sites, but we have them. Lake Mariner is a prime example of that. So what's the value? I mean, for hyperscaler, the value is going to be price per acre and a return to build out the data center. Price per acre is going to be anywhere from $750,000 to $1.2 million, depending upon the location. They want the power, obviously, and then they're going to give you a return to build a data center anywhere from 7 to 8%, and that's what one of those contracts looks like. As Nazar explained, I think at the end of the day, that's gigantic value because you're then in a different business and a different multiple range in terms of where fundamentally your stock should trade. You're going to trade it 20 times. The two other ways to do it are to sort of, do a colo where you're sort of a little bit like the data center, but you're also a little bit in the cloud. And then the third way is to just buy the machines and go to the cloud and rent the space. Listen, I think the buying the machines and going to the cloud and being in the space is phenomenal, but the machines cost a lot of money. I think there are smarter guys out there on that side of the business. We're all on the energy infrastructure side of the business. And we'll pursue something like that if we have a government contract to sell compute time, we'll do something like that. But the colo is where we're currently focused. And so I think that we're unique in terms of having those kinds of sites available. And remember, attached to TeraWulf is this private vehicle where we have a bunch of sites. And think about it like an MLP where, we ready those sites and then we drop it into the public vehicle. So I think that Iris is probably we're a lot like Iris in that regard. But I think maybe there aren't too many others in that regard. And the beauty of our sites is where we're located, rule of law, water permits, low cost energy. and that we've maintained these sites for a long period of time. So I think there's massive value there that is not reflected in our stock price. It's a bummer. I think it should be, but it's not currently. And I think that if people start to think about the value of our megawatts in addition to the value of our exahash, we'll see our stock trade in different leagues away from where we are today.
Sure. Yeah, I was surprised too, Paul, to be honest, by the reaction to that earnings. And a couple other points we didn't talk about. You guys had a large just north of $15 million depreciation in there as well. Fairly low stock-based comp compared to any of the other miners that have reported. But I wanted to talk about that hyperscaler comment for a second, because my understanding, and this is based on due diligence, it could be wrong, Paul, is you guys have this joint venture originally with Talon at the Nautilus site. Rumor is AWS, Amazon Web Service, has bought out their portion of that. Do you have any concerns about a hyperscaler like Amazon buying you guys out at the end of that contract? Do you think you're going to be able to renew Nautilus? Is a buyout a good alternative for you guys? Can you talk to us a little bit about that?
Sure. So it's not a rumor. I mean, Amazon did buy Talon's portfolio there, but not of the joint venture. Everything away from the joint venture. I'm sure Amazon would likely like to buy that other piece, but that's up to Talon on whether or not they would want to sell. I can't speak for them. Whether or not, we have an expansion right, we've exercised it. We're proceeding ahead, business as usual. That said, if there was a buyout proposal from a hyperscaler for Talon and us, then it's my duty to consider it, and my guess would be that it would be something that we would consider if we were getting paid a significant amount of money, which would only, by the way, demonstrate or prove the value of our megawatts, right, in the first place. So I think the answer is we're currently on the track to expand our facilities there. But if Amazon ultimately wanted to work out a deal with Talon and possibly with us, I mean, Talon can't sell our interest, right? We have our own interest. But if they wanted to buy Talon's interest or buy, the collective interest, it's my job to consider it. It's my job to make sure I get the absolute most I could get for it. And if that pencils out to be a lot more than what we think we're going to do from Bitcoin mining, sure, we'd be silly not to consider it. And then take that capital, having shown the world that, look, the value is in the megawatts just like it is in the exahash, and then reinvest that capital because we're prudent investors, and we get a great return on every dollar we invest in our space. I mean, we develop exahash less expensively at Lake Mariner than we do at Nautilus. That'd be a great trade. I mean, but, I don't know where you heard the rumor. It's a good one. I like it, but I haven't heard it.
Yeah, well, even the rumor and even the discussion of Amazon in the same sentence as you guys is really exciting, Paul, and it just goes to show the point of what you're saying is these megawatts, this infrastructure is extremely vital, and big players are looking at it. Now, my next question for you guys, shifting gears back to the self-mining a little bit, I'm curious to ask you, we've asked a few CEOs kind of big picture where they see the Bitcoin mining industry heading. Now we're post-halving, the block rewards are reduced, obviously Bitcoin price is down, people are looking for alternate revenue streams as you alluded to. But I wanted to ask you, Paul, because you've got a really extensive history in the energy space, where do you see kind of the future of self-mining for these companies? Will there be pure plays still, or do you think it's going to be a smaller division within these larger power companies?
I think people should really examine these companies' power contracts because you could talk a lot about all sorts of stuff, whether it's energy capture or new tech and stuff. But if you don't have good power contracts, you really don't have a business. So, that just means that, the companies out there that don't have great power contracts, I think you'll see the result of that in second quarter earnings, right? That's when I think the rubber meets the road. We'll be okay because, we have really good power contracts, and whether the price is 65,000 or 50,000, we're profitable. So I think that at once second quarter results are in, you'll see a lot of companies, again, if they don't have great power contracts, I don't think they'll be terribly profitable. And I think that will lead to a shift in thinking about the space. I think for that shift, we're not there yet. And, this space gets a lot of diehard fundamentalists in it. And it seems like everybody, is picking teams and they're pretty passionate about it and stuff like that. And I'm actually responsible for being a little fiery and passionate myself, because I feel almost like it's important to speak for the space. Not that anyone's elected us to do that, or anyone else for that matter, but I want profitability and profitable, responsible growth, or responsible dilution and profitability to be what the space is all about, so that the businesses that investors are, focused on are, you really build businesses here that are meaningful. So I think after second quarter earnings, we'll see some businesses that just don't make sense. And I think that you'll see a few big ones that do, because they have low cost, sustainable power. At that point, and by the way, I think we'll be one of those. We may not be one of the larger one of those, but we'll be one of those because we're profitable. And then I think you'll start to see the work really beginning, where you're going to work on operational efficiencies. There'll be meaningful consolidation of entities they both must be profitable, because at the end of the day, if we bought a company and they ended up with our stock, they would expect to see an increase in the stock. So you got to see these combinations that would make a lot of sense. Otherwise, why bother? We've already seen, a merger in the industry. You just mentioned one where, 1 + 1 equaled less than 2. And so, you really got to focus on combinations that make a lot of sense. But I don't think that, unfortunately, I don't think that we'll see a lot of that happening until after second quarter earnings, when people, the emperor will have no clothes, if you will. We'll see. Okay, they're making this because Bitcoin's here and their operating costs are there, or they're losing that for that reason. And I think when that happens, investor sentiment will focus more on profitability, as opposed to, hey, I'm on this team. Sometimes investors and Bitcoin miners like Baltimore Ravens fans, right? So it's fantastic. And by the way, I'm a Ravens fan too. So I'm hoping that after second quarter earnings, there's a shift in that mindset. And I think we have tried to facilitate people to think about it, but maybe too passionately and not as in a constructive way, and maybe in a way focused on others as opposed to just focusing on what we're doing. So we're really focused on limited dilution to meet profitable growth, but that if we can demonstrate to the market that we can dilute more and achieve more profitable growth, then we'll do that too.
Makes sense. And yeah, Q2 we talk about as kind of the reckoning, because Paul and I were just mentioning beforehand, the HODL companies obviously benefited in a big way in Q1 from the FASB fair value adjustments of their balance sheet Bitcoin. However, with the price of Bitcoin right now, unless we see that creep back towards 70,000, Q2, like you say, is really going to be a reckoning period for these companies. Now, Paul, you talk about kind of some of the growth opportunities on the horizon.
Say something on that, Bryce. I mean, as you know, Patrick's been out there a lot. We don't have a HODL strategy. We use our free cash flow to service that debt. Then, we'll grow. If you don't have other uses for your capital, from a CapEx perspective, or maybe from putting in a nice structured piece of debt, because I think the market will allow that sooner rather than later, right, for the proper institutions. And then HODL's okay, but as a CEO, I don't feel I'm being paid to sort of take a bet on Bitcoin pricing. I'm paid to generate Bitcoin at a profit. And so, I don't think HODL per se is bad if you can't figure out what else to do with your capital and you want to hold on to it and you keep it in Bitcoin. But I think that, again, that's not what our investors, are expecting from us. And if it's a great strategy because Bitcoin goes up, that's great. But if Bitcoin goes down, what do you do then? And I don't have the answers to those questions, so we don't worry about it. We focus on taking our Bitcoin, selling it at the market, funding CapEx and debt pay down.
Yeah, that makes sense. And speaking of capital allocation, you guys are at 8 exahash. You've announced plans to get up to 13 exahash. You've got option agreements in place for these mining rigs. We're really hearing right now, Paul, that there's no bottleneck on rigs at all. Pretty much you can place a purchase order, get them right away. Talk to us about your self-mining growth strategy, and as you guys kind of pass that infamous 10 exahash milestone, what that enables you to do.
So we have the capacity to multiply, our hash rate as much as anybody. Because we have the megawatts and we have the infrastructure and we have the land. All of our existing hash rate expansion ideas are at sites with proven operational excellence. So, and proven, we build our own facilities so we can manage our costs really well and continue to get the benefits of scale in our pricing. All of our expansion is at sites where we control the energy and we have super low cost energy, right? So while we're not in heavyweight per se in exahash, we are in EBITDA, right? So our intention is to use our earnings to, again, pay down debt and expand. But I think you have two other things. One is, I think we could probably refinance a portion of our debt as opposed to just pay it all down. Currently, the plan is to pay it all down, pay it all off. But I think institutions and a lot of Bitcoin miners should start to think about debt because it's not dilutive if you could get it at attractive terms. Currently, our strategy is to pay it all off, use our free cash flow to do that. And then we use our free cash flow to grow. And will we use an ATM? Yeah, we're going to use the ATM. It's a terrible thing I just said because unfortunately everyone else says we're not going to use the ATM. Then they use it, they dilute the heck out of the world, and then it's in the rearview mirror, and so nobody cares because they put it in TechSet. But we will likely use the ATM in a considered, thoughtful way to grow our exahash if we can absolutely and unconditionally come to the view that we're going to generate a significant return to our investors. Otherwise, we won't do it. So we have the megawatts, we have the sites, we have the low-cost energy, and we're going to grow on the back of that. And until we put up that exahash, in the meantime, we're enjoying the benefit of the increased value of those megawatts.
Sure. And Paul, you talk about repaying the debt, but I believe you said you paid $70 million since Q4 of last year. You guys have already taken a good chunk of this debt, eh?
Yeah, I think we have another $20 million that we're going to pay down over the course of the next quarter. We'll be down to $50 million, and again, not a big number. As you know, we've had a very good relationship with the lenders. We'll just pay them off with their free cash flow, unless it makes more sense to look at a refinancing. And then take that cash and use it for exahash growth.
Now, Paul, we've heard a few leaders or CEOs starting to talk about the debt lever, which was previously not really used in this sector for good reason. Is that just becoming more of a potential now because of interest rates, or is it because the industry is more mature and the lenders are more willing to deal with the miners, or your individual relationship, or why is that now more relevant?
I think they're talking about it. I don't know if for most it is relevant. I would imagine for folks like us, folks like Iris, it's always a possibility because we have the infrastructure, right? Sure. I mean, the lenders like the infrastructure. So lenders aren't big commodity players, and so they still don't like the volatility of coin, and I don't think they'd want to make a loan on betting on that. I think in order to get a loan, one would have to show that you're very profitable in mining, and you'd have to have real collateral, like in the case of us, it's the energy infrastructure and all that sort of good stuff. So I think some of the talk seems a bit hopeful to me, because in order to borrow, you'd have to demonstrate real transparency in terms of all of your costs and your ability to be profitable and stuff. And most folks don't own their own energy infrastructure, whereas a few of us do. But I do think institutions are more comfortable in general with Bitcoin. And the notion before was simply, you're related to Bitcoin, we're not going to lend at all. Now I think a lender is saying, you're related to Bitcoin, that's okay. Now walk me through all the traditional things that I as a lender would want to see, and we could decide whether something makes sense.
Sure. Yeah, I appreciate the explanation there, and we're definitely starting to hear that word come up more and more. Now, Paul, we've talked about a lot here. We've talked about earnings, self-mining growth, the HPC endeavors, your facilities. Is there anything else that we're missing here from the Wolf Pack in terms of upcoming catalysts or things that people should be aware of here?
Again, I think the most important thing that we could try and do is do a better job of communicating constructively. I'll be responsible for that. I'm a passionate guy, and I like to win. The second thing we need to do is just continue to focus on execution of our business plan, because I think that between building 5 coming up at Mariner, the expansion at Nautilus, we're on mission to generate real exahash, and our exahash generates real EBITDA. Again, if you take a look at, we were 32 million in EBITDA with 8 exahash. Please put that in context in terms of the space, and realize that I don't feel we need to be 50 exahash, to generate the kind of earnings that the market would find compelling. We just need to generate exahash that is profitable and has best in class earnings. And then no matter what, people like us. I think on the data side, we're learning. It'd be pretty easy, Bryce. I'm sure TeraWulf tomorrow could go sign a deal with the hyperscaler, but we don't want to, because we don't know enough to say that deal will yield the best return to our investors. I get it if you're an investor and you're frustrated and said, sign a deal already and get me that multiple, but we can't do that. We have a fiduciary duty to our investors, to ourselves, to make sure that the deal makes the most sense in terms of retaining that long-term value, to building a business. Nazar, my co-founder, he says, we want to build a business, not do a trade, so that's the way we're thinking about data. So one should expect that a trigger event could be, we get to a place of real learning. And by the way, we mentioned on our earnings call, the 2 megawatt facility that we're standing up, at Mariner, and then another 10 megawatt facility that we're pushing out for colo. These are really significant. And I think that the success of these 2 ventures will prove our thesis and enable us to really go much harder at the data business. So I would say, look at what we're doing with Talon, look at what we're doing with our data center, particularly the 2 and the 10 megawatt facilities. And then look at what's happening in the energy infrastructure space. Read the Goldman report, read the Morgan Stanley report, and tell us if you think we're being valued fairly, given the fact that we already have that infrastructure that everyone else can go and get. And Bryce, when you think about the infrastructure, also, you have to think about it in terms of time, right? You can't put up a new power plant like that. It takes a few years, right? We have power that we could feed immediately into the market in 24 and 25. I don't know if anyone else does. I think when other people are talking about power, we're talking about 26, 27. That's a gigantic advantage when focused particularly in mining and where you have real volatility, but also in the data center space. Because guys like Amazon, they want the power, they want to put it online tomorrow. So the increased value in our stock should be first and foremost a reflection of the value of our energy infrastructure, and then our continued ability to execute. I think that, if you look at, I think we did a great job with first quarter earnings, and I'm disappointed that we haven't communicated in a way to see our stock being completely revalued. But I think that, when second quarter is reported and you see the kind of money that we continue to make, I think that will excite people and have them, stay true to their investment in us.
I'll stay true, Paul. I'm an investor. This is at Wolf's a top 3 for me hold, and I personally like the passion and the strategy that I see from you at Wolf. So no apologies needed there, Paul. And I think that passion, sometimes the butting heads a little bit or contention is good for the industry because it leads to change, right? And it makes people question their decisions. And I know I've talked about HODL before and non-HODL before. We've talked about asset light versus infrastructure owned or vertically integrated. And like you say, Paul, this industry is so new. No one really knows where it's going or who will be the ultimate winner, but I do think you have merit in saying we're not going to bet on Bitcoin going up with investor money, and we're going to take this methodical, profit-driven approach to growth rather than just dilution at any cost, eh?
I hope so. I mean, that's the strategy, and I, it's what it just feels the right path for us. If we weren't long energy infrastructure, maybe we'd be problem solving from a very different perspective. But because we are long that energy infrastructure, I think it's best to figure out the least expensive way to invest to yield the greatest return. And that's what we're going to continue to try to do. That and our operational expertise. We don't talk about it on these shows a lot, but I have a guy, Nazar in title is our chief operating officer and chief technology officer, but he's really a co-founder, true partner, technology guy, and a strategic visionary for the business. Our operations is run by a fellow by the name of Sean Farrell. Really, he's head of ops. He's a monster. And if you take a look at the operational efficiency of our facilities, I mean, they blow me away. I mean, I've been in the power business for 30 years. Our operational efficiency is due to this guy and all the troops he has on the ground. And, we have a woman who does a lot of social media for us, Chloe Turnbull. She puts out some cool videos. You should look at some of these videos because she really focuses on the troops at plant level. But take a look at the operational efficiencies of our facilities, because that drives both the low cost that we do it at and the uptime that we run at. That's what's driving that, earnings per exahash. And so, big bravo Zulu to Sean and his team. And I think that it's something worth considering, again, when you're looking at, investing in Bitcoin mining. And I believe that Sean and his team are capable of running in a multitude of price environments, a multitude of environmental considerations, regulatory considerations, and just dealing with plain old machinery. I think we're fantastic in that regard. I don't think we give those guys enough credit. So it's another reason to think about the Wolf.
For sure. And you're definitely right, Paul. Wolf consistently ranks in the top in terms of Anthony's efficiency, generation per exahash, revenue per petahash, all of those metrics. You guys are always a top contender. So you definitely have the operational efficiency dialed in. I chalk that up to your military background, Paul. I feel like you probably run a pretty tight ship over there.
We do. Apparently, when Mike Alfred saw Patrick Fleury and he said, how involved is Paul in the business? And Patrick Fleury giggled and he said, he only calls like 25 times a day. And when I was on, the Twitter space, I said, it's not 25, it's only 15. And the answer is that we have good chain of command here, but it's less military, more real partnership in a sense that, the team's been together a very long time, and I'm older than everyone else on the team, and that has taught me I should listen more and maybe speak a little bit less. And so whether it's Carrie, who's our CSO, Nazar, or Patrick, or even our legal team, we get really good ideas, and then we're pretty rigorous in putting them through the grinders. And then when we want to execute, that's the driver. When I was in the power business, I always had the view that give me a change order and it's a job, a severance pay, because I don't like change orders. We want to think about everything in advance. We want to really get it right, and then we want to execute. And here we are in Bitcoin mining, and I think it's all about execution. And again, how else would you explain our earnings for exahash, right? Some people are out there at double our exahash and less earnings. And so it's really about operational excellence. And again, I think it's having the right people, them being incentivized. Sure, Nazar's great. I work hard. Kerry's unbelievable. But Sean Farrell and that operating team they are the monsters in our company, and worthy of everything we can do for them.
A cut above, eh? Well, I've met you, Chloe, and Nazar, and I would say you guys are pretty hard workers. So if Sean and team outworks you guys, then that's probably a pretty big testament, Paul. I agree with you. I think the reaction to Q1 was a little off. I think there's value here. I really think this energy infrastructure, not only is it valuable now, Paul, but this stuff is going up exponentially as more AI demand, HPC, high performance compute comes into society. So I think you're sitting on a bit of a gold egg or a nest egg there, so to speak.
You just gave me an idea, Bryce, because I think that's exactly right. And so I would expect people should just buy us up just on the back of that. But there's a counterpoint to it, which is, okay, what if you don't have that energy infrastructure? If you don't have that energy infrastructure today, because if you don't, tomorrow's too late. If you don't have it today, then you're competing against all those folks to get it for your growth later. So, you could, and that just means maybe you get it, but you're getting it at a much higher price point.
Exactly.
Then makes one think about, is that going to be profitable growth? So I just think that you got to think about it both ways, right? It's like, we should be valued for the energy infrastructure, but at least on a relative basis, you should look at, if you don't have that in-house today, how are you going to achieve profitable growth? What are those power contracts going to look like when you say you're going to 30 or 40 or 50 exahash? What do those power contracts look like?
Yeah.
Patrick puts our power contract terms out there, and so I think he's been amazing, in leading with transparency. But I think at the end of the day, his philosophy has been, let's get really good power contracts. Let's own our energy infrastructure, and we'll be okay. Maybe not today, maybe not tomorrow, but we long-term will build the business. So I hope people ultimately come to that view and join up.
Yeah, that works for me, Paul. That's how the market works. It takes money and it gives it to people with patience. So that works for me, that strategy. Now, I know we've covered a lot. If there's anything we forgot here, Paul, I'll throw you the mic to close out, but I really appreciate your time. Congrats on what I thought was a great Q1 earnings, and it seems like a very well laid out and thoughtful approach to growth this year. Is there anything else you want to throw in here, Paul, before we wrap up?
No, Bryce, thank you so much for your time. Thanks for having me on. Good to see you again.
You're most welcome. We look forward to having you back in Q2 here and see how things progress. You guys, if you have any questions we didn't get to today, leave them in the comment section below. Specifically, if they're more financial questions, we're going to get Patrick Fleury on, the CFO, next time, along with Anthony, and we'll get into the financials. Paul, really appreciate the time today, you guys. If you're still watching, hit the like button, subscribe, and we'll see you tomorrow.